Nobody talks about the two countries quietly producing some of the most financially resilient households on Earth right now, and neither one of them is Japan. South Korea's household savings rate hit 8.7% in 2025, more than double America's, while the average Korean family simultaneously carries significantly less consumer debt per capita than their American counterpart, according to OECD data. Denmark, meanwhile, regularly ranks among the top 5 countries in financial well-being despite income tax rates that would make most Americans faint, because the structural habits underneath Danish financial life absorb shocks that destroy American budgets completely. Now look at the American side of that comparison. The Federal Reserve's 2024 SHED report confirmed that 37% of U.S. adults still cannot cover a $400 emergency without borrowing or selling something. The PYMNTS intelligence research from January 2026 found that roughly 2/3 of American consumers are living paycheck to paycheck right now in 2026, including a genuinely shocking share of households earning well above 6 figures. The gap between these countries and America is not income. The gap is not luck. The gap is 12 specific structural habits that have nothing to do with earning more, hustling harder, or chasing the next trending investment product. Welcome back to Liana Invests. And if you are new here, this channel covers exactly this kind of framework, the structural stuff that actually builds wealth quietly over decades without gimmicks or get-rich-fast promises. So hit subscribe right now and stay with me because this script is the kind of content I built this channel to deliver. Number 1, the Korean Guy Accountability Savings Circle, modernized. In Korean communities across generations, families participated in a Guy, a rotating savings group where each member contributed a fixed monthly amount and one member received the entire pool per cycle. The mechanism was never primarily about the money. The mechanism was the social accountability of showing up every single month in front of people who knew you personally. The 2026 American version does not require pooling funds. It requires 3 or 4 trusted friends or family members who agree to share a private monthly check-in, net worth change, savings rate for the month, total non-mortgage debt balance, one financial mistake from the past 30 days, and one decision being considered for next month. According to Charles Schwab's 2026 Modern Wealth Survey, Americans now define wealthy as $2.3 million in net worth, a number driven heavily by social comparison with curated social media content. The Guy Circle replaces that toxic comparison with structured honesty. The group meets once a month for 45 minutes. No advice gets offered unless requested. The only mechanism is speaking real numbers aloud to people who will see them again next month. That single structural change outperforms most paid financial coaching programs the same households would otherwise consider. Number 2, the Danish 48-hour rule for all purchases above $150. Denmark consistently ranks among the wealthiest nations per capita in Europe, and Danish consumer culture carries a concept deeply embedded in everyday life: the deliberate pause before any meaningful purchase. Research from behavioral economists at Copenhagen Business School replicated across European consumer studies confirms that a mandatory waiting period of 48 hours eliminates between 60 and 70% of non-essential purchase impulses completely. The brain that desperately wanted the item on Tuesday afternoon typically does not recognize the same urgency on Thursday morning. Apply this to American spending in 2026. Every non-essential purchase above $150 gets written on a physical list with the date and sits untouched for 48 hours minimum. Items above $300 wait a full week. Items above $500 wait 30 days. The list becomes a graveyard of cravings that die on their own without requiring willpower in the moment. A household practicing this single rule typically eliminates 12 to 18 non-essential purchases per year worth $200 or more each, which is $2,400 to $3,600 annually that stays in the account and moves to savings instead. Number 3, the Korean Jeollyak principle, which translates roughly as strategic frugality with purpose. Korean households that build multi-generational wealth do not practice random cheapness. They practice deliberate, targeted reduction in categories that produce no remembered value, while spending intentionally in categories that produce documented well-being. The practical application requires a monthly audit of every spending category with one specific question applied to each line item. When I try to recall a specific moment of enjoyment or benefit from this category last month, can I name one? Categories that cannot produce a single named memory get cut by 30 to 50% the following month. Categories that produce multiple specific memories get protected. The average American household, according to Empower's 2025 spending data, carries $273 per month in active subscriptions, much of it on autopilot and unremembered. Jeollyak applied to subscriptions alone typically recovers $800 to $1,500 per year in the first audit, with zero felt sacrifice, because the categories being cut were producing no remembered value in the first place. Number 4, Nordic lagom budgeting, the enough principle applied to every spending category. The Swedish concept of lagom has no perfect English translation. It means approximately just the right amount, not too much, not too little, exactly enough. Swedish and Danish households apply this principle across every spending category simultaneously, not as a rule about one thing but as a cultural orientation toward sufficiency in everything. The American translation is structural. Every spending category in the monthly budget gets a lagom ceiling, the amount that produces full satisfaction without excess. Groceries have a lagom ceiling. Restaurants have one. Clothing has one. Entertainment has one. The ceiling is not the minimum possible. It is the amount above which additional spending produces no meaningful additional satisfaction. Research from Princeton cited in 2025 financial well-being studies confirmed that emotional well-being in American households rises with income up to a certain point per category and then plateaus completely. Spending above the plateau produces no measurable happiness benefit. Lagom budgeting is the structural practice of identifying that plateau for each category and refusing to spend above it regardless of income. The household earning $90,000 that practices lagom budgeting often builds more net worth than the household earning $130,000 that has not identified its sufficiency ceilings. Number 5, the Korean savings rate escalator, 1% per quarter. Korean financial culture carries a strong social norm around savings rate visibility. It is not uncommon for Korean families to discuss savings rates openly the way American families discuss sports scores. And the cultural expectation is that the rate moves upward consistently across a working lifetime. The American application is mechanical and modest enough to be invisible. Increase the automatic savings rate by 1 percentage point every single quarter, not every year. Quarter 1 at 6%, Quarter 2 at 7%, Quarter 3 at 8%. The annual income raise that most American workers receive in the range of 2 to 4% absorbs the quarterly escalation completely. The lifestyle never feels reduced. The savings rate reaches 14% by the end of year 2 with no dramatic sacrifice at any single moment. The math across a 30-year working career on a $70,000 household income starting at 6% and escalating quarterly produces retirement assets that dwarf the same household stuck at a flat 8% forever. Same income, different protocol, radically different outcome. Number 6, the Danish cash envelope system for high-frequency categories. Denmark's payment culture, despite being one of the most digitally advanced economies in Europe, maintains strong behavioral awareness around physical cash for high-frequency spending categories because Danish consumer education explicitly teaches the psychological research on payment friction. MIT Sloan School of Management research replicated multiple times since the early 2000s confirms that physical cash spending produces measurably lower expenditure than card spending on identical categories. The friction of counting bills and watching a wallet thin slows the transaction and makes each purchase register as a genuine loss because it is one. The application for American households in 2026 is direct. Withdraw a fixed weekly cash amount every Sunday for restaurants, coffee, bars, and convenience purchases. Load it into a labeled envelope. When the envelope empties, that category closes for the week. No negotiation, no card backup for those specific categories. According to Empower's most recent data, the average American household spends $179 per month on food delivery alone. The cash envelope system applied to dining and coffee categories typically reduces those two categories by 30 to 40% within 60 days without the household making a single conscious willpower decision. The wallet makes the decision automatically. Number 7, the Korean concept of bunsu, surplus allocation before lifestyle expands. Korean financial culture carries a deeply embedded norm that any income increase, raise, bonus, tax refund, or windfall gets structurally allocated before lifestyle has any chance to expand to absorb it. The mechanism requires a pre-commitment made at the moment of the income event, not days later when the lifestyle expansion has already begun. The specific allocation that Korean financial advisors frequently recommend for unexpected income is 70% to savings or debt reduction, 20% to a meaningful one-time experience or item, and 10% to immediate enjoyment with zero guilt. The structural key is the 70-20-10 rule gets applied within 48 hours of receiving the funds, before any spending conversation happens. The average American tax refund in 2025 was approximately $3,100. Applied through Bunsu allocation, $2,170 reaches savings or debt reduction, $620 funds one meaningful experience, and $310 gets spent freely on whatever the household wants in the moment. The household that spends the full refund on lifestyle within 2 weeks is the statistical norm. The Bunsu household is not. Number 8, Nordic friluftsliv, free outdoor living as entertainment budget compression. The Norwegian concept of friluftsliv, which means open-air living, describes a cultural orientation towards spending leisure time outdoors in nature as a primary form of recreation rather than as an occasional activity. Norwegian, Swedish, and Danish households spend significantly less per capita on paid entertainment categories precisely because free outdoor recreation has been culturally elevated to the highest form of leisure rather than treated as the backup plan when nothing better is available. The American household entertainment budget, according to Bureau of Labor Statistics data, averages over $3,400 per year and has been climbing. Friluftsliv applied to American life does not require Scandinavian weather or geography. It requires a deliberate monthly calendar decision to schedule at least 2 weekends per month around free outdoor activities, hiking, cycling, public parks, beach days, river days, free community events, and farmers markets, before paid entertainment options get considered. The household that shifts 2 weekends per month from paid entertainment to free outdoor recreation typically reduces its entertainment category spending by $150 to $300 per month with a measurable improvement in reported well-being scores because the research on nature exposure and happiness consistently favors outdoor time over consumer entertainment. Number 9, the Korean study of hangbok spending, happiness return on investment per dollar. Korean behavioral economists have published substantial research on what they call hangbok return, the happiness return per dollar spent, and the consistent finding across Korean consumer studies is that Americans dramatically overspend in categories that produce low hangbok return while systematically underspending in categories that produce high hangbok return. The high return categories across multiple studies are experiences shared with people the household cares about, investments in health and physical capability, learning new skills, and home environment improvements that affect daily life. The low-return categories are status-signaling purchases, fast fashion, dining at expensive restaurants for social obligation rather than genuine enjoyment, and luxury versions of commodity products. The practical application is a quarterly spending review that color-codes every significant purchase from the previous 3 months as either high hangbok or low hangbok based purely on the honest memory of enjoyment. Categories that are predominantly low hangbok get reduced by 25% the following quarter and the freed budget gets reallocated to high hangbok categories. The total spending does not change. The happiness return on the same spending increases significantly. Number 10, the Danish debt repayment sequence, smallest psychological burden first. Danish personal finance education, which is embedded in the secondary school curriculum in a way that has no American equivalent, teaches a specific debt repayment philosophy that differs meaningfully from both the American avalanche and snowball methods. The Danish approach prioritizes the debt that creates the highest psychological burden first, which is frequently not the highest interest rate debt and not always the smallest balance. It is the debt that causes the most daily stress, the one the household thinks about most frequently, the one that creates the most shame or anxiety in daily life. The research basis for this approach is that psychological burden debt repayment produces stronger behavioral compliance than mathematically optimal repayment because the emotional relief of eliminating the most painful debt creates the motivational fuel to continue the repayment plan across the months that follow. The household that eliminates its most stressful debt first frequently outperforms the household following a mathematically optimal sequence precisely because the emotional relief sustains the behavior while the mathematical optimization produces no emotional return until the very end. Number 11, the Korean Indian principle applied to financial relationships, investing in people who multiply your financial capability. The Korean concept of inyan describes the meaningful connections between people as something worth cultivating deliberately rather than leaving to chance. In Korean financial culture, this translates into a clear recognition that the people in your immediate social circle have a stronger effect on your financial behavior than any book, video, or financial advisor you will ever encounter. According to research published across multiple decades of social science, the average person's savings rate, spending habits, and net worth trajectory are more strongly correlated with the financial behaviors of their 5 closest social relationships than with their own income level. The application requires an honest annual audit not of subscriptions or spending categories but of social relationships. Which relationships consistently pull your financial behavior toward discipline, long-term thinking, and intentionality? Which consistently normalize overspending, lifestyle inflation, or financial avoidance? The Yin principle does not recommend abandoning relationships. It recommends deliberately and intentionally increasing the time and depth of the relationships that support the financial life you are building, and being honest about the influence of the ones that consistently work against it. Number 12, Generational Stewardship, the 100-year horizon applied to every major financial decision. Both Korean family businesses and Scandinavian sovereign wealth fund governance share a structural orientation toward multi-generational thinking that simply has no cultural equivalent in mainstream American personal finance. Korean chaebols, family-controlled conglomerates, plan across generations and deliberately structure decision-making to prevent short-term thinking from consuming long-term value. The Norwegian Government Pension Fund, the largest sovereign wealth fund on earth, operates under a governance framework explicitly designed to protect wealth across 100-year horizons for future generations who cannot yet vote. The household application in 2026 America requires a single reframe. Every major financial decision, the house purchase, the car purchase, the career move, the retirement account contribution rate, gets evaluated on a minimum 50-year horizon before the decision is finalized. The house is not can I afford the payment this month. The house is will this asset still serve the next generation or will it require a distressed sale when I retire. The car is not can I get approved for the loan. The car is does this transportation decision align with the financial life I want at age 65. The retirement account contribution rate is not what is the minimum my employer requires. It is what rate, sustained for 35 years, produces the generational wealth I want to leave behind. The shift in time horizon changes almost every line item in the household budget without requiring $1 more of income to implement. Here is the pattern underneath all 12 of these habits. Every single one inserts a structural pause between impulse and action. The Guy circle inserts social accountability. The 48-hour rule inserts time. The Lagom principle inserts a sufficiency ceiling. The Bunsa rule inserts a pre-commitment before lifestyle expansion is possible. The Hangbok audit inserts an honest measurement of what spending actually produced. The 100-year horizon inserts a future generation into every decision before it gets made. None of these habits require a higher income. None require a side hustle, a special app, or a complicated financial product. They require structure, repetition, and a willingness to be slightly out of step with American spending culture for the next 10 to 20 years, while compounding does its quiet work in accounts that do not need to announce themselves to anyone. The Bureau of Economic Analysis confirms the American personal savings rate sits at roughly half its 60-year historical average in 2026. PYMNTS Intelligence found that 2/3 of American consumers are living paycheck to paycheck right now. The Federal Reserve documented that 37% of U.S. adults cannot cover a $400 emergency. These are not statistics about people without options. These are statistics about a structural habit deficit that is entirely correctable starting this month with a pen, a piece of paper, and the 12 frameworks you just heard. If this video gave you even one idea that changes something in your financial structure, hit the like button right now because it genuinely helps this channel reach more people who need exactly this kind of content. And if you are not subscribed to Liana Invests yet, subscribe right now because I upload every single day and the next video covers the specific financial traps at every decade of American life that quietly destroy the ability to use any of these habits in the first place. The traps in your 20s look different from the traps in your 40s, and knowing the difference is the foundation everything else is built on. That video is next and it pairs directly with everything you just heard.